Welcome back to the Deep Dive. Today, we're jumping into a figure who is, I think it's fair to say, one of the most polarizing names in modern finance.
Oh, for sure. Robert Kiyosaki.
Exactly.
Yeah.
And his book, Rich Dad, Poor Dad. So our mission today, using the stack of sources you all sent in, is to really unpack his, let's call it radical financial philosophy, and then hold it up against the wisdom of, well, someone who is almost the polar opposite.
You have to bring up Dave Ramsey. It's the essential comparison.
It really is.
And it's such a necessary conversation because what Kiyosaki does is he just directly challenges the economic programming most of us got growing up.
Right, the whole go to school, get good grades, get a safe job thing.
Yeah. His claim, which is pretty audacious, is that the system is specifically designed to train you to be an employee, a worker. And if you want financial independence, you need a totally different education.
Financial education.
Exactly. He just hammers that point home. It's not about how much you make, it's about how much money you keep. And, how much you can make work for you.
Yeah. And he frames all of this in that incredible narrative, the story of the two dads, which is just so powerful.
It's brilliant storytelling.
On one side, you have his real dad, the poor dad, a guy with a PhD, super educated, a government employee, but he was always struggling with money.
Right. Valued security, worked hard for a paycheck, but was always, tangled up in debt. The classic, highly educated employee.
And on the other side,
you have the rich dad. This is his best friend's father, only an 8th grade education, but he was this wildly successful businessman, an entrepreneur.
and his whole focus was different.
Completely. It was all about acquiring assets, making money work for him. For a long time, people wondered who this guy was, but we now know the character was largely inspired by a Hawaiian hotelier, Richard Wasman Kimi.
But Kiyosaki always says the identity isn't the point.
Right. It's the philosophy. The mindset of a capitalist and investor versus the mindset of an employee.
Okay, so let's unpack that philosophy, starting with what he says is the one and only rule you need to know to get rich. This idea of an asset versus a liability.
This is the absolute foundation of everything he teaches. He basically throws traditional accounting out the window and simplifies it to one thing.
Cash flow.
All about cash flow. His rule is, and I'm quoting here, you must know the difference between an asset and a liability and buy assets. If you want to be rich, this is all you need to know.
So what does that actually mean?
In his terms.
It's super simple. An asset is anything, and I mean anything, that puts money in your pocket. It generates positive cash flow every month, whether you're working or not.
So like a rental property that's making money after expenses.
Exactly. Or a business that runs without you, or stocks that pay dividends. And a liability is just the opposite.
That's money out of your pocket.
Yep. Negative cash flow, car loans, credit card debt, most of the stuff people buy.
And this is the definition that trips everyone up, isn't it? Because under this rule, your house, the place you live, is usually a liability.
This is where he loses a lot of people. Yeah. For the average person, your home is a cash flow negative thing. You've got the mortgage, taxes, insurance, upkeep.
It's all money going out. All money out. So even though a traditional financial advisor would call it an asset on your balance sheet, Kiyosaki says if it's not paying you, it's a liability.
But hold on a second. What about the tax advantages? You can deduct mortgage interest, property taxes, and what about appreciation? Isn't he just ignoring the fact that it's building equity over time?
That's a fantastic point, and it gets to the core difference. Conventional advice looks at future value equity, what it might be worth. Kiyosaki is obsessed with right now. Present-day cash flow.
So if it's tying up your money today,
then it's preventing you from buying something that could be paying you today. He tells this great story about wanting a sailboat, a total liability.
oh yeah, a hole in the water you pour money into.
Exactly.
Yeah.
So instead of just buying it, he put it into a charter company. The income from chartering it out paid for all the boat's expenses. He turned a huge liability into an asset he could still use.
So the rich focus on buying assets that generate income, and the poor and middle class just buy stuff that creates expenses.
You've got it. And that leads perfectly into his next big concept, the map he uses for all this, the cash flow quadrant.
The ESBI. He says it's not how much you make, it's how you make it.
That's the key. So the quadrant has 4 letters, E, S, B, and I.
Okay, break it down for us.
Okay, you've got a left side and a right side. The left side is all about security. That's E for employee. You trade your time for a paycheck. And S for self-employed or specialist.
A doctor, a lawyer, a consultant.
Right. They value independence, but they don't own a business, they own a job. If they stop working, the money stops. He actually says the S quadrant is the riskiest,
And here's the kicker. Both E and S get paid with ordinary earned income.
which is taxed at the absolute highest rates. The tax code punishes that kind of income.
So where's the freedom?
The freedom is on the right side. B is for business owner. They own a system, and people work in that system. Their income isn't tied to their time.
And then I.
I is for investor. This is where your money is working for you. You own assets, real estate, stocks, businesses that generate cash flow.
So the goal is to get from the left side, trading time for dollars, over to the right side where you're free. But that jump, especially from S to B, that seems huge.
It's a massive jump. You have to stop being the one who does the work and become the one who builds the system that does the work. It takes a whole different skill set and a lot of discipline.
Which brings us to the great divide. Kiyosaki versus Ramsey.
Yep. Because Ramsey is all about that discipline, but for a very different audience.
Right. Ramsey is talking to the person who's just drowning in debt.
Exactly. He's talking to the person with 12 grand in credit card debt, the family that financed a trailer for 48 grand. His message is almost moral. Debt is evil. The borrower is slave to the lender.
He's trying to stop the bleeding.
Totally. It's a system to create a solid foundation. But Kiyosaki, he agrees bad debt, consumer debt is terrible, but he fully embraces good debt.
Using other people's money to buy assets that pay you.
Right. He says leverage is how you get rich. The whole economy is built on borrowing money. So he sees debt as a tool, where Ramsey sees it as a trap.
And that split continues with, well, the American dream itself, home ownership.
Oh, this is a huge one. For Ramsey, your house is a key asset. Pay it off, build that stable net worth. Kiyosaki and guys like Grant Cardone, they hate that idea. They call the equity in a paid-off home dormant.
Dormant money. Just sitting there.
It's just sitting there. They'd say, why have $300,000 locked up in a house that's not paying you? Take out a line of credit, pull that money out, and buy an asset that generates income.
But what about the peace of mind? I mean, a paid-off home, there's a security in that that's hard to put a price on.
And that's the difference in values. Ramsey prioritizes security. Kiyosaki prioritizes efficiency and accelerated returns. It's the same with their view on discipline.
Ramsey is all about budgeting, cutting back, living below your means.
The millionaire next door model. Kiyosaki is about expanding your means. He hates the phrase, I can't afford it.
He says you should ask, how can I afford it?
Exactly. And that question forces you to think like an entrepreneur. It makes you focus on creating new assets instead of just cutting back.
Their advice on investing is just as different. Ramsey's pretty standard. 15% into Roth IRAs, mutual funds.
Yeah, good, solid, traditional advice. And Kiyosaki looks at all that, savings accounts, 401k, mutual funds, and says it's incredibly risky.
Because you have no control.
No control, and you don't understand it. He has that famous line, savers are losers. He means that if your savings account pays 1% interest and inflation is 3%, you are literally getting poorer every single year.
Your purchasing power is eroding.
Guaranteed. So for him, risk isn't about the market going up or down. He defines it as an acronym. RISK.
Reckless investing sans knowledge.
You got it. If you just hand your money to some expert and you don't know what they're doing with it, that's the biggest risk you can take.
Which leads to the last big point of contrast. Taxes. Ramsey doesn't talk about them a whole lot, at least not in the beginning.
Because his audience is trying to get out of credit card debt. They're not worried about sophisticated tax strategy yet. Kiyosaki makes taxes central to everything.
Right. The whole reason to move to the B&I quadrants is the tax advantages.
Absolutely. The government's rules are written to incentivize business owners and investors. You know, with real estate, you get depreciation, a massive paper loss you can use to offset your actual income. The system rewards you for playing the game on that side of the quadrant.
So it's all about mindset. Kiyosaki always says the problem isn't the investment, it's the investor.
Yes. Warren Buffett said, risk comes from not knowing what you're doing. Kiyosaki just takes that and runs with it. The less you know, the lower your financial intelligence, the more risk you're taking.
And he says to learn, you have to overcome something he calls selective distortion.
It's basically our mental defense mechanism. We reject new information if it threatens what we already believe.
So if you believe your 401k is the only safe way to retire,
You'll hear Kiyosaki's warnings about fees and lack of control, and you'll just tune it out. You'll find a reason why it doesn't apply to you. You stick with what feels safe, what everyone else is doing, instead of what might actually be rational.
can you give us a quick example of that?
Sure. Imagine a successful doctor, an S quadrant person. They've got 100 grand in a mutual fund. They read about a real estate investor getting 20% returns, But the idea of being a landlord, just, it scares them.
Bad tenants, midnight phone calls.
All of it. So their selective distortion kicks in. They focus only on the risks and completely ignore the potential returns and tax benefits. Their fear justifies sticking with the safe mutual fund, even though it guarantees they'll reach their goals much, much slower.
The fear of control just locks you on that left side of the quadrant. Okay, so after this whole deep dive, what's the synthesis? Who should you actually follow?
It totally depends on where you are. If you're in stage 1, you've got a ton of student loans, credit card debt, Dave Ramsey is your guy, no question.
You need that rigid structure to stop the bleeding.
You need the financial hygiene. His plan works for getting you to zero, to a clean slate.
But once you're there, once you're consumer debt-free, you move into stage 2.
And that's when you graduate to Kiyosaki's principles. You pivot from debt elimination to wealth acceleration.
Acquiring assets, generating cash flow.
Using good debt, diversifying, you're moving from playing defense with your money to playing offense.
This has been a really fascinating look at these two. It's clear their advice isn't one size fits all. It's about what stage of the game you're in.
That's the perfect way to put it. At the end of the day, Kiyosaki's core idea is simple. Stop focusing only on working harder for more money. Start focusing on acquiring assets that make money for you.
Thank you so much for sharing your sources and letting us unpack all this today.
Of course. But before we sign off, let me leave you with one last thing to think about. It's for anyone who's in that wealth building phase. Given Kiyosaki's critique of fees and things like 401ks and mutual funds, consider that Jack Bogle, the founder of Vanguard, once calculated that over a lifetime, the financial system's fees and costs could eat up nearly 80% of an investor's potential returns.
80%, that's staggering.
It is. So here's the question. Are the investments we're all told are safe and conservative actually the riskiest choice for you in the long run? Because they almost guarantee that you lose control and that you'll keep a much smaller piece of the pie. Something to think about.